Welcome to the Fear and Greed Business Interview. I'm Jennifer Duke. The Australian economy expanded 0.4% over the June quarter, and it's up 2.1% on an annual basis. But on a per capita basis, we're in a recession, and the government's warning it's going to get worse from here on out. Here to discuss what this all means is Diana Musina, Deputy Chief Economist at AMP. Diana, welcome back to Fear and Greed.
Thank you, Jen. It's a pleasure to be back.
So can you break that stat down for us a little bit? What was behind the result and how did it compare to what you were expecting?
We actually saw quite large divergences in the components of GDP. If you break it down, it will show you that consumer spending rose only 0.1%, which is extremely weak. And there was a huge contribution from net exports. Export growth was much stronger than import growth. And the government added a decent contribution as well to June quarter growth, and there was a large fall in inventories. So what do you make from all of this? I suppose the good news is that domestic demand is still holding up thanks to government spending, the consumer contributing a little bit, and business investment, I forgot to mention, was also pretty good, and the forward-looking indicators for business investment are still holding up. But the economy has clearly slowed from its highs last year, and we expect that there will be some further slowing from here from the impacts of tighter interest rates. That per capita recession may feel real to some people, but at the same time, we have had a very strong labour market in the past 12 months. So it's difficult to say that conditions in the economy are weak. There are obviously pockets of weakness, but the unemployment rate is still around a 50-year low. So that per capita recession, I think, will just generate more headlines than it's actually worth.
That makes me feel a little bit more positive. So that's nice, to be honest. So Treasurer Jim Chalmers did say at his press conference yesterday that we're on that pretty steady footing. And like you said, we're sort of expecting a bit of a slowing. How concerned do we need to be, though, about China on the impact for outlook?
Well, if you look at the export numbers, you wouldn't even think that China was a problem to Australia because export growth was still extremely strong. I mean, China is obviously only part of the story, but they are our major trading partner. If you look at things like the iron ore price, though, or other commodity prices, you haven't really seen much of a weakening in those prices, which to me suggests that for our key exports to China around commodities, there is still decent demand from China. Maybe not as strong as it was 10 years ago, but it's still enough to support Australian growth. The part of GDP that I'm most worried about is around the consumer. And I think if we were to have a recession next year or a significant downturn, the consumer would be the one that drags us there.
And obviously we've had a couple of months since June, so we're already a little bit further into that than perhaps these figures are suggesting. Has there been more of a slowing in that consumer element since then?
Well, as at the June quarter, discretionary spending had fallen by 3 consecutive quarters, and that's only up to June. The retail data over the past few months has been pretty bad, and that suggests to me that the GDP figures will continue to show weakness in the consumer. The savings rate is likely to keep coming down because consumers will continue to draw on those savings. So I think that we will see some further weakness in the consumer, and the sentiment numbers don't really fill me with any joy either because consumers are still saying that they don't feel very optimistic about the outlook.
Definitely. And I think the Reserve Bank was looking pretty closely at those figures when they met on Tuesday and kept rates on hold. Given sort of the GDP data and that thought that you have around the consumer spending, do you have any views on where rates might be headed next?
I think that the likelihood of a pause to interest rates from here is extremely high. You would really need to see a change in the inflation or wages environment to justify another rate rise from here, given that the RBA has been on hold for 3 consecutive months. There is no real need for them to hike interest rates again. Things are moving in line with their projections in terms of GDP growth. Inflation's actually coming in better than their forecasts. If we did see a renewed surge in wages or the labour market continuing to be extremely tight, then maybe that would justify another rate rise from here. So there is the possibility of another rate rise in the next few months, but it's not our base case. And we think that the next move will be a cash rate cut sometime in the first 6 months of 2024.
Stay with me, Diana. We'll be back in a minute. I'm speaking to Diana Musina, Deputy Chief Economist at AMP. The home building industry is usually a pretty solid contributor to GDP, but it kind of isn't actually anymore based on the looks of the data yesterday. So do you think it's going to pick up again, or are these sort of long haul issues in the industry that are playing out?
Well, in a rising rate environment, it is difficult for residential construction to be solid, and that will continue to be the case. If we look at the building approvals data, it's not very strong either, which suggests that new housing construction will still probably remain weak. But the only, I guess, source of upside is potentially the government trying to focus on lifting housing supply. That could result in some more construction, which would add to GDP growth.
Definitely. And the other big change that Jim Chalmers announced yesterday was a new Productivity Commission chair, Danny Wood from the Grattan Institute. What do you think is her big challenge in terms of tackling the big productivity problem?
Well, productivity is really the buzzword lately because it looks so dreadful when you look at the data, and it leads a lot of people to ask me, like, are we really more unproductive than we've ever been? And I don't really think that that's the case, because there is still some, I think, post-pandemic issues that are filtering through the data in terms of measuring productivity, but also the very big increase in hours worked is keeping a lid on productivity growth, helping it to look extremely low. There are many issues that need to be addressed in the economy around productivity. So things like taxation reform, incentives for business investment, trying to lift business investment, what's the optimal rate of business tax rates, helping to increase education standards in the country, increasing housing supply, trying to get the right balance of population growth for the economy given our infrastructure challenges. So there's kind of productivity issues in every single sector of the economy. So I don't envy her role at the moment, because productivity is a long-term issue that needs to be addressed through reforms, but they take a long time. So we're not just magically going to see a lift in productivity growth. It will take some time for it to rise.
And Danny's been pretty vocal on that tax reform piece and the need to kind of get a bit of an overhaul in the GST space and bring us to maybe a bit of a new horizon. Do you think that message is going to be listened to by the government? Are you sort of on the tax reform side?
Well, economists usually like tax reform, so I think I have to say yes, because taxation reform tries to reduce some inefficiencies in the system and ultimately try and make the system fairer and get rid of taxes that aren't benefiting the economy. And I suppose if they've appointed her as the new chair, then the government is serious about trying to tackle tax reform. So I really hope that it is something that they look into.
And I just want to go back to that per capita recession issue as well, because clearly you said that it's going to generate a lot of headlines, but perhaps not as many practical effects. Are you concerned at all about those headlines and the way that they might impact people's perceptions on population growth and migration settings?
Bad news always sells, I think. And whenever you look up things around the economy, there's always someone predicting a crash or recession, because I think it's often easier to be negative than it is just to say, well, things can just turn out okay and not be too strong or too weak, but just moderate. So I don't think it's helpful to get people worried about recessions. It's important to keep in mind that we could experience a downturn because we have had such a significant lift in interest rates that there will be some consequences of this. And one of those consequences will be a slowing in GDP growth. Hopefully, we don't need to go down the path where GDP growth crashes, but it is important to be cognizant that we will have a further slowing in activity from here, but not necessarily to get people worried about the outlook.
And one of those other effects of high interest rates that everyone always assumes is going to happen is a very rapid drop in property prices. But it doesn't seem like that's actually happening anymore. Have you been surprised about what's going on in the property market?
Extremely surprised. And a part of the reason is definitely around the tight rental market and the surge in population growth. I guess I didn't expect that population growth would rise at such a quick pace in a very concentrated number of quarters, I guess, or even months. I thought that our population growth numbers would have started to increase last year, but there was definitely a delay post the pandemic, and it all seems to be coming right now. And we just don't have the levels of supply to meet the demands of population growth. So that needs to be addressed. And I suppose the government is trying to address those housing supply issues. But the issue is that they just, it doesn't, if you want to build a house, it doesn't just happen in a day. It can take months, if not numerous months, if not close to a year. So that's sort of the issue. I really hope that the lift in housing supply can ease some of the tightness in the rental market. But the strength in the housing market is definitely surprising, although I don't see the pace of growth that we've had over the past few months continuing. I think that we will see some softening in the pace of property price growth, especially coming into next year.
Definitely. Diana, thank you so much for talking to Fear and Greed.
Thank you.
And that was Diana Musina, Deputy Chief Economist at AMP Capital. This is the Fear and Greed business interview. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Jennifer Duke, economics correspondent for Capital Brief, and in the chair for Sean Aylmer. Have a nice day.